In September 1998, the president of the New York Federal Reserve made phone calls that would save the world economy. He wasn't calling governments or central banks. He was calling Wall Street's biggest players, demanding they write checks totaling $3.6 billion to bail out a single hedge fund. This wasn't just any fund. Long-term capital management had 2 Nobel Prize winners on its board. The smartest mathematicians from MIT and Harvard, and the former vice chairman of the Federal Reserve. They'd turned $1.25 billion into $140 billion in assets using borrowed money, a leverage ratio so extreme that when they started losing, they nearly took down every major bank on Wall Street. Here's the part that should terrify you. These were the smartest people in finance. They had computer models that supposedly made losing money impossible. They'd made 40% returns year after year. Banks were so eager to lend to them that they didn't even ask what LTCM was doing with the money. And in just 5 weeks, they lost $4.6 billion. That's roughly $100 million every single day. Today, you're going to learn how the most sophisticated investors in history nearly destroyed the global financial system, why the Fed had to secretly orchestrate their rescue, and what this means for your money today. If you want to understand the economic disasters that shaped our modern financial system, the ones that happened while most people weren't paying attention, hit that subscribe button and the notification bell. This is The Sleeping Economist, where we uncover the financial stories you slept through. Chapter 1. The Setup. This story begins in 1994 with John Meriwether, a legendary trader who'd just been forced out of Salomon Brothers after a treasury bond scandal. But Meriwether wasn't finished. He had an idea that would revolutionize investing. What if you could remove human emotion from trading entirely? What if you could use pure mathematics to find tiny pricing errors in the market and exploit them for guaranteed profits? Think of it like this. Imagine 2 identical houses on the same street. One sells for $300,000, the other is listed at $305,000. You know they should cost the same, so you bet that the prices will converge. You short the expensive house, betting its price will fall, and buy the cheap one. When prices normalize, you profit from both sides. This is called arbitrage, and Meriwether wanted to do it with bonds. He assembled what journalists would later call the best finance faculty in the world. Robert Merton and Myron Scholes had literally just won the Nobel Prize for creating the Black-Scholes model, the mathematical formula that revolutionized options trading. David Mullins had been vice chairman of the Federal Reserve. The team included professors from MIT and Harvard, former heads of bond trading from Salomon Brothers and Goldman Sachs. These weren't just smart people. They were the people who invented modern financial theory. By February 1994, they'd raised $1.25 billion, the largest hedge fund launch in history. Investors included the presidents of Merrill Lynch and PaineWebber, who invested personally. The Italian central bank invested $100 million. Even the Bank of China wanted in. The minimum investment was $10 million, and Meriwether was turning people away. Their strategy seemed foolproof. They'd find bonds that were temporarily mispriced by maybe 0.01%. That's 1 penny on $100. But here's the key. They'd borrow massive amounts to amplify these tiny profits. If you have $1 billion and make 0.01%, you earn $100,000. But if you borrow $29 billion more and make that same 0.01% on $30 billion, you make $3 million. This is leverage, using borrowed money to multiply your returns. The name itself radiated confidence. Long-term capital management. Not speculation, not trading. Management. They weren't gambling. They were using science to manage capital over the long term. Their offices in Greenwich, Connecticut became known as the Casino of the Intellects. Chapter 2. The Build. For 4 years, LTCM was the most successful fund in history. In 1995, they returned 43% to investors. In 1996, another 41%. To put that in perspective, if you'd invested $10 million in 1994, you'd have over $20 million by 1997. They were making so much money that in late 1997, they actually returned $2.7 billion to outside investors. They didn't need their money anymore. Their models were finding opportunities everywhere. When Russia issued bonds paying 17% interest while similar German bonds paid 5%, LTCM bet the rates would converge as Russia stabilized. When Japanese bonds traded differently in London than Tokyo, they'd arbitrage the difference. They were like financial physicists, finding tiny cracks in market efficiency and extracting profit. Banks were desperate to be associated with LTCM's genius. Bear Stearns, Goldman Sachs, Merrill Lynch, they all competed to lend money to the fund. And here's where it gets dangerous. Many banks didn't even require collateral. They were so confident in LTCM's models that they'd lend billions on just a handshake. By early 1998, LTCM had borrowed $125 billion against just $4.8 billion in equity, a leverage ratio of 25-1. But that number actually understates the risk. Through derivatives, complex bets on future price movements, LTCM controlled positions worth $1.25 trillion. That's trillion with a T. That was 5% of the entire global bond market, controlled by just 16 traders in Connecticut. The partners were so confident they put most of their personal wealth in the fund. Merriweather had $150 million invested. Merton and Scholes each had tens of millions. They weren't just managing other people's money. Their entire fortunes were tied to these mathematical models. This brings us to the fatal flaw in their thinking. Their models were based on historical data showing how markets behaved normally. They calculated that the odds of losing everything were essentially zero, less likely than winning the lottery multiple times. But markets aren't physics. They're driven by human psychology, and humans don't always behave rationally, especially when they're panicking. Chapter 3. The breaking point. The first crack appeared in May 1998, halfway around the world. Indonesia, Thailand, and South Korea were in financial crisis. Investors were pulling money out of all emerging markets. LTCM had bet that Russian bond yields would converge with Western bonds. Instead, investors fled Russia entirely. On August 17, 1998, Russia did the unthinkable. It defaulted on its domestic debt and devalued the ruble. LTCM lost $550 million in a single day. But here's what the models didn't predict. The default created a psychological shock. Suddenly, investors wanted only the safest assets. They sold everything risky and bought U.S. Treasury bonds. This was called a flight to quality, and it destroyed LTCM's entire strategy. Remember, they were betting that similar bonds would converge in price. Instead, the opposite happened. Safe bonds became more expensive, while risky bonds crashed. Every single position LTCM had was losing money simultaneously. Think of it like betting on 100 coin flips, where you need just 51 heads to profit. The math says you're almost guaranteed to win. But suddenly, every single coin comes up tails. That's mathematically almost impossible. But in markets driven by human fear, it was happening. By the end of August, LTCM had lost $1.9 billion, 44% of their capital. Their computer models kept saying this was temporary, that prices had to revert to normal. So they didn't sell. In fact, they doubled down, borrowing more to increase their positions. But the banks that had eagerly lent to LTCM were now terrified. They demanded more collateral. When you're leveraged 25-1, a 4% loss wipes out everything. LTCM needed cash immediately, but to raise cash, they'd have to sell positions at massive losses, which would create more losses, requiring more sales. A death spiral. On September 2nd, Merriweather sent a fax to investors. It was meant to reassure them, but it had the opposite effect. He revealed they'd lost $2.5 billion in August alone. The fax leaked to Wall Street within hours. Now everyone knew LTCM was desperate. Here's where it gets truly frightening. Wall Street banks realized they had a problem. They'd all lent to LTCM, but worse, many had copied LTCM's trades. If LTCM was forced to sell everything, it would crash the exact markets where all the banks had positions. Goldman Sachs alone would lose $1 billion. Merrill Lynch, Morgan Stanley, Deutsche Bank, they'd all face massive losses. Chapter 4. The Fallout. On September 20th, 1998, the heads of Wall Street's biggest banks were summoned to the Federal Reserve Bank of New York. This wasn't a normal meeting. Fed President William McDonough made it clear, LTCM's failure could trigger a global financial crisis. The numbers were staggering. LTCM had 60,000 trades on its books with a notional value of $1.25 trillion. If they defaulted, every major bank would face losses. Worse, the forced selling would create a market panic. Banks would stop lending to each other, credit markets would freeze, and the contagion could spread globally. Warren Buffett actually offered to buy LTCM for $250 million, but the offer expired in 1 hour. Not enough time for LTCM's lawyers to even read it. Goldman Sachs proposed a deal that would have wiped out LTCM's partners entirely. Both offers were rejected. McDonough then did something unprecedented. He didn't use government money. That would require congressional approval. Instead, he strongly encouraged the banks to bail out their competitor. On September 23rd, 14 banks agreed to invest $3.625 billion for 90% of LTCM. The partners who'd once been worth hundreds of millions were left with just 10% of a nearly worthless fund. The rescue worked. Barely. Markets stabilized, and over the next 2 years the positions were slowly unwound. The banks eventually made a small profit on their rescue investment, but the psychological damage was permanent. Alan Greenspan, the Fed chairman, later testified to Congress that LTCM's failure could have caused a crisis worse than the 1987 crash. The Fed cut interest rates 3 times to calm markets. The Russian default and LTCM's near collapse wiped out $1 trillion in market value globally. But here's what really changed. Wall Street learned that if you were big enough and interconnected enough, the Fed would orchestrate your rescue. This too-big-to-fail precedent would have devastating consequences a decade later in 2008. Chapter 5. The Aftermath. The LTCM collapse exposed fundamental flaws in how Wall Street managed risk. Banks had lent billions without knowing what LTCM was doing with the money. Regulators had no oversight of hedge funds. The mathematical models everyone relied on were dangerously flawed. Congress held hearings. Myron Scholes, the Nobel laureate, was asked how his models could have failed so spectacularly. His answer was revealing. The models didn't fail. The world changed in ways the models couldn't predict. This became known as model risk, the danger of believing your mathematical model captures all possible futures. New regulations were proposed, but mostly blocked by Wall Street lobbying. The hedge fund industry argued that LTCM was an isolated incident, that the market had self-corrected without taxpayer money. They were technically right. No government funds were used, but they ignored that the Fed had essentially forced a private bailout. The partners of LTCM went their separate ways. Merriweather started a new hedge fund, JWM Partners, which also eventually failed in 2009. Merton and Scholes returned to academia. Many of the traders went to other funds, taking their knowledge but apparently not the lessons. The banks that participated in the bailout made changes. They started demanding more transparency from hedge funds, better collateral, and lower leverage ratios. But these reforms were voluntary and temporary. By 2007, leverage levels on Wall Street were even higher than LTCM's had been. What nobody fully grasped was that LTCM had revealed a new systemic risk. When everyone uses similar models and strategies, they all want to sell at the same time. This correlation of behavior could turn a small crisis into a catastrophe. The 2008 financial crisis would prove this lesson hadn't been learned. The academic world was shaken too. The efficient market hypothesis, the idea that markets rationally price all information, had been dealt a serious blow. If markets could stay irrational long enough to destroy even the smartest investors, what did that mean for economic theory? Chapter 6, The Human Lesson, Extended Version, 1815-20. So what can regular investors learn from LTCM's collapse? The lessons are more relevant today than ever, especially as we see new financial products and can't-lose strategies promoted on social media every day. First, genius doesn't make you invincible. LTCM's partners weren't wrong about their math. They were wrong about human nature. When everyone panics, correlations go to 1. Everything you thought was diversified starts moving together. This is why even today, you should never invest money you can't afford to lose, no matter how sure the bet seems. Second, leverage is a double-edged sword. LTCM turned a 4% loss into total catastrophe because of leverage. Today's retail investors can access leverage through margin accounts, options, and leveraged ETFs. Remember, leverage multiplies both gains and losses. A 50% loss requires a 100% gain just to break even. When someone on social media brags about making 1,000% returns using options or margin, remember they're not showing you the people who lost everything using the same strategy. Third, complexity isn't always sophistication. LTCM's trades were so complex that even their lenders didn't understand them. Today, if you don't understand an investment, don't make it. The best investments are often the simplest ones. Warren Buffett, who tried to buy LTCM during its crisis, has always said he doesn't invest in things he doesn't understand. If one of the world's most successful investors keeps it simple, maybe we should too. Fourth, past performance really doesn't guarantee future results. LTCM's track record was perfect until it wasn't. Whether it's cryptocurrency, meme stocks, or the latest fund manager beating the market, remember that strategies work until they don't. The market has a way of humbling everyone eventually, even Nobel Prize winners. Here's something crucial that most people miss about LTCM. The partners had their own money in the fund. They believed so completely in their system that they bet their personal fortunes. This created a false sense of security for investors. Surely these geniuses wouldn't risk their own money if it wasn't safe, right? Wrong. Today, when you see fund managers or crypto founders talking about having skin in the game, remember that their confidence in their own system doesn't make it safe. Confidence and correctness are two different things. The timing lesson is equally important. LTCM's models were actually right in the long term. Many of their positions would have been profitable if they could have held them for another year. But as economist John Maynard Keynes famously said, "The market can remain irrational longer than you can remain solvent." This is why using margin or having fixed deadlines on your investments is so dangerous. You might be right about the direction but wrong about the timing. And in leveraged investing, being early is the same as being wrong. Consider too the herd mentality problem. LTCM failed partly because everyone on Wall Street was copying their trades. When they all needed to sell at once, there were no buyers. Today, we see this with popular Reddit trades, trending stocks on social media, or crowded cryptocurrency bets. When everyone's doing the same trade, ask yourself, who's going to buy when everyone wants to sell? The exit door is never as wide as the entrance. The regulatory lesson matters for your protection as an investor. After LTCM, regulators talked about reform, but did little. The same happened after 2008. Don't assume that regulations protect you from systemic risk. The system is still fragile, still interconnected, and still capable of rapid contagion. This means you need to be your own risk manager. Diversification isn't just owning different stocks, it's having some cash, some bonds, maybe some real assets. It's not putting everything in the market, no matter how bullish everyone seems. Finally, systemic risk is real and growing. LTCM controlled $125 trillion in derivatives with just 16 traders. Today, the derivatives market is over $600 trillion. That's 7 times larger than the entire world economy. When you see everyone doing the same trade, whether it's buying tech stocks, shorting volatility, or piling into the same cryptocurrency, remember LTCM. The crowd can be wrong, and when everyone heads for the exit at once, the door might not be big enough. The story of LTCM isn't just about a hedge fund that failed. It's about the danger of absolute confidence in models, the risk of excessive leverage, and the interconnectedness of global finance. These aren't just historical lessons. They're warnings about risks that still exist today, perhaps even more so in our age of algorithmic trading, social media-driven investing, and unprecedented retail access to complex financial instruments. The next time someone tells you about a risk-free investment, a guaranteed return, or a strategy that can't lose, remember the smartest people in finance once thought the same thing. They had Nobel Prizes, computer models, and absolute certainty. They still lost everything in 5 weeks. If it happened to them, it can happen to anyone. The market's ability to remain irrational, to move in ways no model predicts, to stay panicked longer than you can stay solvent, these aren't bugs in the system. They're features. And understanding that might be the most important lesson of all. If stories like this fascinate you, where we uncover the economic events that shaped our world while most people weren't paying attention, hit subscribe and the bell icon, because we're just getting started with these financial mysteries.